Welcome to the Deep Dive. Today we're digging into the Q3 2025 earnings call for Johnson & Johnson. This dropped pre-market October 14th.
Yeah, and it's a fascinating one to unpack.
Right, because the setup is, well, it's a bit of a head-scratcher. You got J&J delivering this really clean beat-and-raise quarter. I mean, the numbers look good.
Definitely looked good. Confirmed momentum in pharma and MedTech.
Exactly. But then you look at the market reaction, and it was just flat, maybe even slightly down by the close, despite all this positive news.
And that's our job today, isn't it? To try and figure out that disconnect for you. We need to go beyond those headline results, which, again, were strong, but we need to see what the market was really focused on. What were the strategic points, maybe the financial headwinds?
And maybe what signals the market missed. They talked about a new era of accelerated growth. So what did investors maybe discount too quickly?
Precisely. It's about understanding that deeper narrative.
Okay, let's dive in. Maybe start with the numbers themselves, the headline results.
Good place to start. So like you said, a solid beat. Adjusted EPS, that's earnings per share, came in at $2.80.
And consensus was hovering around, what, $2.76. So a decent beat there?
Yeah, about 4 cents clear. And revenue followed suit, $24.0 billion reported.
Which beat the street view of roughly $23.7 to $23.8 billion.
Right. So again, clearly ahead. And that translates to overall reported sales growth of 6.8% year over year.
Okay, 6.8%. And operational. That's stripping out currency effects.
Operational growth was 5.4%, still very solid.
So beat on earnings, beat on revenue, raised the sales guidance for the year, and the stock just sits there.
Yep. Tells you investors pivoted fast, they looked past the quarter's performance, good as it was, and jumped straight to the future complexities.
You mean the big strategic stuff, like the spin-off plan?
That, and also some pretty significant tax impacts that sort of muddied the guidance picture a little bit.
Okay, so the classic, yeah, today was fine, but what about tomorrow?
Exactly. And to understand J&J's tomorrow, you really have to get into the two main engines, Innovative Medicine, or IM, and MedTech, MT.
And both of those actually reported the same growth rate, right? 6.8% reported in Q3.
They did, which is interesting in itself. Let's maybe start with Innovative Medicine, the pharma division.
Okay.
Because its performance, honestly, it's kind of remarkable given the backdrop. Operational sales were up 5.3%.
And that pushed them over $15 billion again, second quarter in a row.
Right. But the real story isn't just the 5.3% growth. It's what they overcame to get that growth.
Ah, you're talking about Stilara.
Exactly. Stilara's loss of exclusivity, the LOE, that drug used to be a monster growth driver.
And now?
Sales declined 42% in the quarter. 42%.
Wow. Did they quantify the impact of that? Like how much drag that created?
They did. They said it was roughly a 1,070 basis point headwind to the segment's growth.
Okay, hang on. 1,070 basis points. Just to clarify for everyone, a basis point is 0.01%. So 1,070 means Stilara alone knocked 10.7 percentage points off the potential growth rate of the entire Innovative Medicine division.
Think about that. They had to make up a 10.7% gap just to get back to flat before even showing growth.
That's a huge anchor.
Yeah.
And they still managed over 5% operational growth.
It tells you the newer pipeline is absolutely firing. It has to be.
So where's that growth coming from specifically? Which drugs are carrying the load?
Oncology is a huge part of it. The oncology portfolio grew nearly 20% operationally.
20%. Okay, who are the stars there? DARZALEX.
DARZALEX is definitely a cornerstone, still growing 20% operationally for multiple myeloma. And what's amazing is it's holding over 50% market share across all lines of therapy. It's just dominant.
Incredible staying power. What about the newer stuff like CARVYKTI?
CARVYKTI, that's the one to watch. Operational sales exploded, up 81.4%.
81%. What was the actual number?
Hit $524 million in the quarter. And management, they're now talking about $5 billion in peak sales potential for CARVYKTI.
$5 billion. For a CART therapy,
Right.
That suggests they think this is one of the best launches the industry has seen.
It really does. Then switching gears slightly, immunology. TREMFYA is the big story there.
Right. TREMFYA grew, what was it?
40.1% operational growth. Huge acceleration.
And that's mostly the new indications, right? The IBD launches.
Yeah, driven heavily by getting into ulcerative colitis and Crohn's disease. That's opening up a massive new patient population for them.
And management sounds pretty confident about TREMFYA's future.
Very confident. They explicitly said on the call they believe TREMFYA will become a greater than $10 billion asset.
Wow. Okay. 10 billion plus. That's mega blockbuster territory. If they hit that, the market might be really underestimating the IM division's long-term power.
I think that's a fair assessment. And speaking of future power, they highlighted 2 specific pipeline assets they think could each hit $5 billion plus in peak sales.
Okay, this feeds into that accelerated growth narrative they kept pushing. What are they?
So the first is INLEXZO. That just got FDA approval for bladder cancer.
INLEXZO. What's special about it?
It's the delivery system. It's the first and only drug-releasing system for sustained local delivery in this setting. So targeted treatment right where it's needed instead of flooding the whole body. That's a big deal in oncology.
Yeah, minimizing side effects, maximizing efficacy. Makes sense. What's the second one?
The second is a combination therapy for lung cancer. RYBREVANT plus LAZCLUZE.
Okay.
And the data they shared was compelling, showed a statistically significant reduction in the risk of death compared to osimertinib, which is, the current standard of care.
Beating the standard of care head-to-head is always powerful. That gives them a lot of conviction.
Absolutely. So that's innovative medicine, overcoming headwinds, strong pipeline. Now let's flip to MedTech.
The device side. Operational sales growth there accelerated, right? To 5.6%.
Yeah, picked up pace this quarter. And again, it wasn't just broad market lift. It was very focused strength.
Seems like some of the recent acquisitions are really starting to contribute.
Definitely. Cardiovascular was a big driver, up around 12% operational.
And that includes a Biomed, the heart pump company they've got.
Yes, a Biomed itself grew 15.6%. And they made a point to highlight the Danis-Josicce study data.
Ah, yeah, the 10-year data.
Right. Showing their Impella CP device cut mortality by 16.3% compared to standard care in cardiogenic shock. That kind of long-term data is gold for driving adoption.
Clinical proof points matter.
Right.
What else stood out in MedTech?
Shockwave. Remember that acquisition? The integration seems to be going really well. Grew 20.9% operational.
8%. Wow.
And they actually projected that Shockwave will become J&J's 13th MedTech platform to hit $1 billion in annual sales by the end of this year.
$13th billion platform in MedTech alone. That's scale.
It is. And even vision, which sometimes gets overlooked, had a strong quarter, up over 6%. Surgical vision was the driver, up almost 14% thanks to their Technis intraocular lenses.
Okay, so across IM and MedTech, the underlying business performance seems genuinely strong.
Undeniably. Which brings us right back to that paradox we started with.
Why the flat stock if the core business is humming?
It comes down to those 2 big factors the market latched onto. One is immediate, one is strategic. Let's tackle the immediate one first. Taxes.
Right. This was buried a bit in the guidance section, but it seemed important. They raised the sales outlook, but EPS guidance for the full year 2025 stayed the same.
Exactly. Adjusted EPS guide reaffirmed at $10.80 to $10.90 midpoint.
Thanks.
So why no EPS raise alongside the sales raise?
Yeah, what gives?
Taxes. They got hit with a frankly massive one-time tax charge in Q3. Their effective tax rate for the quarter ballooned to 31.2%.
31%. What was it normally or prior year?
Prior year was 19.3%, so a huge jump.
Okay, why such a big jump?
It was mainly due to a $1 billion remeasurement of deferred tax balances. And this was triggered by new federal legislation. They mentioned the One Big Beautiful Bill Act.
Ah, okay. So new tax law hits, forces them to book $1 billion future tax liability now.
Pretty much. It's a non-cash accounting charge mostly, but it hits the reported tax rate hard in the quarter it's recognized.
So basically the strong operational performance, the beat they delivered in Q3, it got eaten up by this tax charge just to keep the full year EPS guidance flat.
That's a good way to put it. They essentially absorbed the beat. Now, you could argue that shows confidence that they could swallow $1 billion hit and still hold the line.
But the headline impact is no EPS raised despite higher sales, which the market probably didn't love initially.
Right. Sticker shock. So that's headwind number 1. Headwind number 2 is the big strategic news.
The Orthopedics spinoff, DePuy Synthes.
Yep. Following hot on the heels of the Kenvue consumer health spinoff last year.
What's the timeline they gave for this one?
They're targeting completion within 18 to 24 months. So sometime in, say, late 2026 or early 2027.
Okay, but wait. We just did Kenvue. Now we're spinning off Ortho. Is this a sign they just can't manage these big, diverse businesses effectively? Or is it really about strategic focus?
They're framing it entirely as strategic focus. Portfolio optimization. The idea is simple. Orthopedics is a solid business, but it's generally lower growth and lower margin compared to innovative medicine and the remaining more specialized parts of medtech.
So spin it out, let it compete as a pure play in its own $50 billion plus market.
Exactly. And allow the remaining J&J to be a more focused, higher growth, higher margin company focused on cutting edge pharma and medtech.
Okay, that makes sense strategically. But what's the tangible financial impact? What does this do for the remaining J&J's numbers? That's what investors care about.
And they gave a specific number, which was crucial. They said if you look at the pro forma results, so J&J without Orthopedics, MedTech's top-line revenue growth and its operating margin would both improve by at least 75 basis points.
75 basis points. Okay, 0.75%. That might not sound like a ton to some people.
But for a company this size, adding 75 basis points directly to MedTech's operating margin is significant. That's pure profit improvement potential, and it compounds.
Right. That's the margin unlock story the market seems to be maybe discounting right now because the spin is still 18, 24 months away.
I think that's exactly it. The uncertainty around the process is overshadowing the potential outcome.
And that margin expansion must be why they sounded so bullish looking further out into 2026.
Absolutely. They gave some pretty strong signals about next year. They said they believe 2026 revenue growth will actually beat the current consensus estimate, which sits around 4.6%.
Beat 4.6%. Did they say by how much?
They projected growth of over 5% for 2026.
Okay, over 5% top-line growth next year. And what about earnings?
Similar story. They see upside to the current 2026 adjusted EPS consensus, which is around $11.39. They hinted at potentially as much as 5% upside there, too.
So faster revenue growth and potentially faster earnings growth than the market currently expects for 2026.
That's the message they wanted to send, driven by things like TREMFYA continuing its tear, plus new contributions.
Like the OTTAVA surgical robot. They mentioned that, right?
Yeah, planned submission for the OTTAVA soft tissue robot in the first half of 2026. That's another potential catalyst.
Okay, this feels like a good point to pivot. Let's put on our hypothetical hedge fund hats for our This Is Not Financial Advice segment.
All right, let's do it.
So the setup is Q3 beat and raise got ignored. Markets hung up on the tax hit, which is temporary, and the ortho spin execution, which is longer term. What's an outrageous but plausible trade for someone who buys into this margin unlock story?
Okay, the trade has to center on capturing that medtech margin improvement, the 75 basis points, while trying to sidestep the uncertainty around the actual spin-off process itself.
Right. How do you isolate the benefit without taking on all the execution risk of carving out DePuy Synthes?
So the pitch would be something like this. A long position in J&J, looking out maybe 12 to 18 months, but crucially, you structure it as a pairs trade.
Long J&J, short something else.
Exactly. You go long J&J for that core IM and remaining medtech growth story. But you hedge the orthopedics piece specifically by shorting a comparable, dedicated, probably lower growth, pure play orthopedics company.
Ah, I see. So if the ortho spin-off valuation comes in lower than expected, hurting J&J slightly, your short position in the ortho peer should theoretically gain offsetting that specific risk.
That's the idea. It neutralizes or at least dampens the noise around the DePuy Synthes valuation and separation mechanics,
allowing you to focus the bet purely on the margin expansion and the accelerated growth profile of the remaining J&J, the innovative medicine, and the higher growth medtech parts.
Precisely. It's a conviction bet on the success of their portfolio optimization strategy.
And what's the catalyst? When would this trade ideally play out?
The key catalyst would likely be around mid-2026, when we should start getting more concrete details about the spin-off structure, the financials, the leadership for the new ortho company.
And once those details emerge, the market should be forced to recognize that 75 basis point margin uplift.
That's the thesis. The clarity should validate the margin improvement story, leading to a re-rating of J&J as a more focused, higher growth, higher margin specialty healthcare leader.
Okay, interesting idea. Not advice, of course, but an interesting way to think about it.
Just thinking out loud.
All right, let's wrap this up. To recap our deep dive today, J&J delivered a strong Q3 beat and raise.
Yep, confirming that their big pipeline assets, DARZALEX, TREMFYA, CARVYKTI, are really stepping up and successfully offsetting that huge Stilara erosion, that 10.7 percentage point headwind.
But the stock traded flat, largely because investors focused on two things. That surprising $1 billion tax hit from the One Big Beautiful Bill Act.
And the announcement of the big orthopedics DePuy Synthes spinoff, which adds complexity in the near term, even though the goal is that significant 75 basis point margin boost for the remaining medtech business long term.
So the key takeaway for you, the listener, is probably management's confidence. They're projecting accelerating growth into 2026, aiming for over 5% revenue growth and seeing a potential EPS upside too.
Yeah, keep an eye on that spin-off execution timeline for DePuy Synthes and definitely track the commercial momentum of those big pipeline drugs they keep highlighting, especially the ones with $5 billion plus potential.
It's all about whether they can execute on this new era strategy.
That's the multi-billion-dollar question. Thank you for joining us for this deep dive into the J&J Q3 2025 earnings call.
Until next time, stay well informed.